What's poppin', investors? Today I'm going to show you how to de-risk some of your option plays by showing you an actual trade I did on JD stock. Here it is. I sold some puts, 29 contracts to be exact, out expiring next year around the same time for $13,500 almost, and then I bought them back for $11,750. So around $1,700 worth of profit, and it took me about 2 weeks to do it, a week and a half. Now it requires a few things to execute this trade, okay? So I call it de-risking because time is no longer as much of a concern for you when you're playing with leaps. Leaps are long dated options basically. What's required though for this to work is that you need to do some fundamental work. Like, I am a big proponent of doing fundamental work for all my trades, for all the companies. If I don't feel comfortable with owning the stock, I will not own it. Okay? I'll just do something else. I don't want to deal with a company where I'm not sure what's going to happen. Nowadays the trend has been this, right? Everybody's a momentum trader. Either you're riding the Tesla train, or before that it was GameStop train or whatever. Now it's like AI, Nvidia train, or even just investing in a good company like Apple but a little bit overvalued. It seems like everyone's kind of pushing, into the stock market in very select areas, just trying to chase momentum because there's so much on the back, right? This wave is not going to crash for a while. And that seems to be the trend, like how people are making money nowadays. But I try to stay away from the hypes myself and try to find unique and different ways to make money in the markets. And this is one of them. I like to trade leaps. So, of course, I'm trying a bunch of strategies on this public account here, but this is just one of them. Now, here's what happened. Here's how to do it. If you have any kind of brokerage, by the way, it doesn't have to be Robinhood. This is Robinhood's interface because I think it's really easy to read. What you want to do is, first of all, select the date that you're willing to play on. So I had selected, June next year, 2024. That's 348 days away. And then you want to try to select a price that you're comfortable with after clicking sell put, right? So you're going to be selling some puts, which means basically that if the price goes below the certain amount that you want, you're going to have to own that stock. So if I sell 30 contracts, that means that come June next year, if the stock is below 32.5, I'm going to end up owning, let's see, what's 30 times 100? Like 3,000 shares, okay, of JD.com, which is quite a bit. So if you're not comfortable with that, don't do it. Do a lesser amount. Do 10 contracts, 5 contracts, 1 contract, whatever. So it's a little bit safer than buying the stock outright, because even though you don't participate in the upside as much, as heavily, if you end up buying the stock in a year from now, right, it's going to be at a much lower price. So there's going to, the break-even point is going to be a lot lower than that price that you set. Plus, you're going a little bit below the strike price anyways, so you're giving yourself a margin of error there. And also, because of the premium, you're giving yourself additional margin for error. So even though the current price is, let's say, 35.8, you might end up getting it, at 30 next year, right? Because let's say the strike price that you were trying to aim at is 32.5, and then the additional premium that you're going to get for the trade is going to be quite a bit. So you're going to end up paying like 30 or below. I don't see the break-even price over here. I thought it said the break-even price, but whatever. You can guesstimate it based on the premium amount. And so what you do here is, right, you sell some puts, you click continue, it gives you right here JD price at expiration. Okay, so 28.35 is the break even. So you got quite a big margin of error, right? Everything below 28.35, you're going to start losing money. And this graph tells you how much money you're going to lose, right? So if JD drops all the way down to 25, you're going to be, down $300 per contract. So you click continue. You type the number of contracts that you want. Let's say just one, right? Minimum credit 415. That's how much you're going to get. You click preview order. And over here, it's going to tell you how much collateral is required for this trade. So that's another one of the catches, is that you're going to need to have cash up front in order to execute, right? You're promising that you're going to buy stocks at 3,200, stocks at $32.50 per. So that means you need $3,250 on hand. Now, part of that can be margined out, but you need to have at least half of it in order to enter the trade, and perhaps even more than a half. It depends. Every brokerage has different rules about that. If you're an international trader and you're using Interactive Brokers, then or some other platform, then you could probably lever up quite a bit. They can trade certificates for deposit overseas. They can trade all kinds of instruments to lever up dramatically. So you don't need that much money, and depending on your jurisdiction. In the US, like 1-to-1 leverage is pretty standard. I think you need like special licenses or something in order to increase the leverage past that. And if you want to use margin, some brokerages don't even let you use 100% margin. You may, especially for option plays like this, you may have to do 50%. So, you're just going to have to look up the rules yourself. But for, I think, Robinhood, you need to have more than half of the money in order to put up enough collateral. But anyways, what you can do is you can pick a stock like Ford, for example, or some other stock that is has a less nominal value of the stock. All right, so Ford is, I don't know what it is, like $15-$20, or you can pick something cheaper, and then you can actually pull off the trade. You can do multiple contracts depending on how much cash on hand you have. But anyways, you need to make sure, this is the key part, is that you need to make sure that you're okay with owning the stock at a certain price in a year, right? If you're okay with owning JD at 28.5, then you can enter this trade and sleep well, right? And what's going to happen is, once you click this submit button, what's going to happen is time is on your side now. So if JD decides to pop up, all right, let's say for me, it ended up popping up yesterday or a couple of days ago. When was it? Yeah, a couple of days ago. Actually, I think so. Anyways, or was it today? Shoot, doesn't matter. The point is, it popped up, and I decided, you know what? I could wait the entire time and collect the rest of $11,000, or I can just take my $1,700 right now, and that's a good payoff for a couple of weeks, right? $1,700 in a couple of weeks is a good payout. So then perhaps I'll find a different opportunity to deploy that money in. And that's like a smart way to do it. Of course, not every strategy is foolproof. You could end up losing quite a bit. Like if the stock in question ends up getting cut in half and you're levered up, I mean, you're going to be hurting, right? So you got to really make sure the fundamentals are solid in the company and there's no like shady business going on. By shady, I mean like you got to try to see what's on the horizon a little bit. Like, okay, so is their debt going to be a problem? Do they have enough cash to survive all this time? Do they have like foolish management, or at least overly ambitious management that's going to run the company a little bit into the ground, or overspend more than they could handle and turn into a little bit of a growth company? Or, you just got to kind of see what's on the horizon and follow the company. If something changes about the company, right, if they all of a sudden become super aggressive, then it may not be the best idea, right, to use that company as collateral. So pull the money out, find a different company. Even if you lost a little bit, it's better than losing all of it. You see what I mean? So find a different company to employ that strategy on and go from there. Like, like I said, it's not as good on the upside as buying the stock, but it gives you quite a bit of margin for error there. And if the stock hasn't bottomed yet, this method is very good for bottom fishing. That's how I use it anyways. if the stock hasn't bottomed yet, then you still have a little bit of room to go before you start crying uncle, right? And another good thing about these leap options too is that the premium holds its value fairly well, even if the stock drops, right? So it's less volatile than the actual equity on the upside and on the downside. It actually is, because if I were to buy, all the stocks, then I'd have what do you calculate? 3,000. If I had 3,000 shares, right, up 5% on that 5%, that would destroy my entire account. So in this case, the contracts are actually less volatile. Options are less volatile than the underlying stock. So you can, it's not, options are not always risky. You can use options to express anything in the market. That's why I really like them, because you can de-risk, or you can escalate risk, or you can make it, you can make it a flip 50-50 kind of play. Like, you can express any kind of view by using options and equities, a combinations of the two. And so that versatility is priceless. It actually does have a price. All right. Before I start, jumbling up my words any further, I want to end this, and let me know if you've tried this strategy and what you think, or how do you de-risk your option plays. Like, there are many ways. It's just one of them to take on less risk and still have a big play. But let me know what you do in order to make sure that you're sleeping well at night when using options. All right. That's it for now. Peace out.